And we're live. It's Friday. Happy Friday, team. We're figuring it out here. We're getting it figured. It's being figured. All right. See if I can figure the music out here. Still working on buttons. I have a few different things I'm going to try today. We'll see if they work. I'm going to actually try to use the buttons from my other platform. So that's a little test right there with the applause and the buzzer. All right. So much stuff to get through today. Huge payroll number today, which is really, really good. You know, we get into this, are we in that bizarro world? I remember when this started in 2008, it was in the mortgage business. I was trading Dow Jones futures in the mornings. It was a crazy time. And I remember when it sort of shifted to like bad news is good news and good news is bad news. Because bad news means the Fed will get involved. And if the Fed gets involved, that means we're going higher. If we have good news, then the Fed won't get involved. And that means it just kind of takes the wind out of the market sales. Isn't that weird? I liked it when bad news was bad and good news was good. I thought that was much easier. So let's take a look at this. We're going to go through all this stuff today. So payroll report, we're going to talk about, we're going to go through mortgage bonds, what's going on there. We've lost some ground. Going to talk about Sprout Mortgage, which shut down yesterday and really caught a lot of us off guard. I had a deal that was supposed to fund with them yesterday. Total disaster. You know, we're picking up the pieces, of course, but it is what it is. We'll talk about what's going on with rents a little bit as well. We'll see how much we get into on that front. But let's start right here. So, you know, the big payroll gains. And notice this. This is something I told you they were going to do this. They're going to continue to act like we're not in a recession. Big payroll gains push recession fears into the corner for now. Okay. So they're not going to officially come out with the GDP number for Q2 and, you know, anytime soon. I think it's a couple weeks still or 2 or 3 weeks. And so, you know, they're going to continue to act like we're not in a recession. We are, but it's okay. Recession just means we're not growing. We may be recessing a little bit, coming back after lots of growth. It's okay. June's big payroll jump helped clear away some recession fears for economy that could still see consecutive quarters of negative growth. So some of the fears of the recession. And, you know, this payroll number, so job gains, 372,000, convinced most Wall Street economists that the idea of a first half recession is fanciful, as one put it. 3.6% unemployment rate is hardly consistent with an economic downturn. These are all things I've been telling you, but it's true. Here's another article where they said that U.S. Treasury yields extend gains as bond markets continue to flash recession warning. The inversion has happened. The 2-year, 10-year yield curve inversion has happened. This is a key recession signal. It's already in place. But notice how they're saying that it's just a recession warning signal. Here's where the jobs are. I love this jobs report. And listen, I'm not just like a bullish individual. I'm not just, actually, I'm it's weird. I'm actually super bearish. My normal mode is bearish, skeptic. I'm a skeptic. So right now I'm skeptical of the fear that is going on and is being perpetrated. And I'm just challenging it with real data. So if you look here, the June jobs, this is just 1 month net change. It looks good. I mean, I don't know how it could be better. Maybe it'd be better if there was more construction jobs or utility jobs, maybe financial activities jobs, people being laid off there. But look, negative 9,000 government. Oh, it's perfect. We're growing jobs everywhere and we're losing jobs in the government. That's beautiful for me. I love that. That is the best thing ever. So the jobs report smashed. Doesn't mean that the markets took off though. And this is what I was saying. So you see the market's very flat today. How? Why? How could that be? Great jobs number. Was it priced in? Were people expecting this? The big boys knew this was coming in? Or is it back to bizarro world where good news is actually bad because that means the Fed is less likely to intervene? If we had a bad jobs report, we would need several, maybe even a year's worth, if that's all we had for the Fed to intervene just solely on that. So it just kind of, it takes the Fed intervention out of play. And that's the reason why the markets don't really like it. Check this out. This is actually bullish too. Goldman slashes GDP forecast for the second quarter to just barely above water. Barely above water? Well, so Goldman sliced here. Its second quarter outlook for GDP to just 0.7%, down from the previous expectation 1.6. If it ends up being positive, then technically we wouldn't be in a recession, right? I mean, that would be much better because the real expectation here was definitely negative, like negative 2%. So if they really think it's going to be positive at all, that would be a big positive upside surprise for everything. So let's see. Let's see if Goldman has it. Oh, I was going to put it. So also, we're talking about market bottoms and like the psychology of just how this works. This guy here, who's a really big bull, his name Stoltzfus from Oppenheimer, he's a huge bull, and they say he's one of the biggest bulls left. And he cuts his S&P 500 outlook. Perfect. Listen, in order to find a bottom, the most bullish people have to get not necessarily bearish, but they need to stop being so bullish. So I see things like that, and I go, that's bullish. Adjustable rate mortgages are really in the news a lot right now. There's definitely, demand has tripled since January because rates have spiked up. A lot of these adjustable rate mortgages are 5, 7, or 10 years fixed. It's really not a big risk to do an adjustable rate. I mean, you want to know what you're getting into, of course. Read your disclosures, look at your APR. There's certain disclosures for ARMs that you need to take a look at, but it's pretty safe. You get a 5-year fixed, 7-year fixed, 10-year fixed, adjustable. So it's fixed for 5, 7, or 10 years, and then it adjusts after that. You're going to have an opportunity to refinance. I'm just going to tell you right now, you'll have an opportunity to refinance between now and then, as long as you don't, mess up your credit or do something like that in the meantime. So it's not as risky as it seems or as it's maybe been in the past. And the rule of thumb is always when rates are high, get an adjustable rate. When rates are low, get a fixed rate. It's very simple and it makes a lot of sense. Because also people who are getting adjustable rate mortgages right now, if rates drop, it's very possible that their adjustable rate will drop. Now you might get an automatic refinance. Now, it would still make sense to Dan, I think, but those things happen, especially back in the 70s. My dad was telling me about that. One of the houses that he bought. So, okay, we're going to talk about Sprout Mortgage real quick, and then we're going to dive into mortgage rates. So Sprout Mortgage, they shut down operations yesterday. Apparently this was in the news Wednesday. I didn't see it. And then Thursday morning, we got the call. Actually, we got an email saying, hey, this is not a drill. We're shutting down. We're closing our doors. We had a loan that was supposed to fund that day, yesterday, with them, and another one in process. So is this like a bad sign? There's another non-QM bank, First Guarantee mortgage company, which also shut down operations just a couple weeks back. These are non-QM lenders. Why is this happening? Is this a bad sign? When I posted about this on my story on Facebook, someone said, hey, just like 2008, almost as if to say, see, I told you, just like 2008. But that's definitely not what's going on. This seems to be more isolated. And the thing with non-QM, back then we had, if you think about back in 2008, we had actual banks shutting down. It wasn't just mortgage companies or like subprime mortgage lenders. The banks were closing. Washington Mutual went out of business. Bear Stearns went out of business. We're so far away from that. I can't even tell you how far away we are from that. The amount of leverage that's allowed and just everything is so far away from that happening. We're so far away from a 2008 type situation that it really is silly to talk about it. And the only reason I talk about it is because there's so many ding dongs on YouTube who make crash videos every day and talk about it. So everyone's talking about it. And buyers are sitting here going, I'm going to wait because I think we're going to hit a recession and things are going to get worse. I think property values are going to get crushed. There's going to be a crash. Buyers are saying this every day, left and right. And it's tough. It's tough because you sit there and you go, man, we finally have a market that is amenable to buyers. We finally have a market that's good for buyers, and the buyers don't want anything to do with it. And it's what I was telling you for a long time, that people will say, I'll wait till a crash comes to buy real estate. But when the crash comes, they just won't be able to pull the trigger. They just won't. It's so hard to do. You have to train yourself You have to train yourself emotionally, psychologically. The investor mindset is hard. It's hard. You have to buy when no one wants to buy. You have to sell when everyone thinks you're crazy for selling. When I sold my house in 2006, everyone told me I was an idiot. Like, why would you sell your house, dummy? And so I was an idiot for like a year, and then a genius ever since, right? Because yeah, I'd rather sell too early than too late. I'm telling you right now, there's no reason to sell. I mean, unless you have to, obviously. So Sprout Mortgage, First Guarantee Mortgage Company, these guys had liquidity issues. I'm going to explain that is very quickly. Essentially, when they're trading non-QM loans means that they're not normal. Let's just put it that way. Normal loans, Fannie Mae, Freddie Mac, FHA, VA, conventional loans. The jumbo world and the non-QM world, somewhat intertwined. Most jumbo lenders operate separately and kind of in their own way and do other stuff too. And then non-QM is sort of its own beast. Bottom line is this: when rates are going up quickly, they still have to offload this paper somewhere. They're not a bank. They're not making these loans so they can collect the payments and make the interest over the long haul. They want to shift the paper to someone else. So when those investors who are buying that paper say, hey, we don't want it anymore, they have nowhere to send those loans. Sending those loans to those investors is how they make revenue so that they can pay for their operations. So if they're not able to do that, then it's over. And that's what's happened. Whoever it is that's been investing in these non-QM lenders is basically saying, we want to tighten up. We don't want to put money into this anymore. We don't want to be involved in this. And it's caused liquidity issues. And First Guarantee went down. And now Sprout's going down. Non-QM is essentially the new subprime. Well, what's good about it is you have to have good credit. You have to have down payment. It's not like subprime was at all. So it's not a bad thing. It's really not. They're much safer investments. I would much rather give someone a non-QM loan than a Fannie loan with my own money. I mean, you're telling me for Fannie, you can go put 5% down and buy a house that you're upside down on day one because the cost of sale is called 7%. I wouldn't want to loan you my money for that deal at 5% interest, but I can invest my money at 7% interest in a non-QM deal where there's 25% down. I'm down with that. So I don't think it's like it was back in the day where people with 600 credit, 620 credit. I remember 620 Nina, 620 credit score. You could buy no income, no assets needed. You could buy a house, 100% financing. 620 credit. That was before the crash. Okay. So we are so far away from that, guys. This isn't even remotely close. I've included a couple of links here so you can kind of check it out and read up on it yourself about what's going on with those closures. But it is definitely more one-off. It is more specified. It's not industry-wide. There's no macro issue there. It's really just a specialty issue. And by the way, there's still a bunch of other non-QM banks. In fact, I was getting emails from other non-QM banks saying, oh, Sprout closed. What you need? What deal can we pick up for you? And so, yeah, I would not worry about that from a macro perspective whatsoever. All right, let's take a look at mortgage bonds. And unfortunately, so yesterday, didn't have time to make a video yesterday. I was putting out fires left and right. But this is what we were looking at. We were really hoping that would hold right there. And it did. That was the exact line that we had. And we held yesterday just barely, very small range yesterday. Didn't look good. Didn't look like buyers were interested. And we did. We broke the trend line. And so now, we're over here. We just still not a bad looking candle, but we closed below multiple layers of support that we had crested through just a couple of days ago earlier this week. And things are looking really good. So not looking so great at the moment, but also not looking terrible. Rates haven't gotten like a lot worse or anything, but we're not at where we were here at our best moment. We're worse off than we were then by, let's say, 100 basis points, call it 0.25% in the interest rate. But it's interest rates are still much better than most people believe. So let's keep that in mind. Another thing too, on the rental side, I thought this was really interesting. Rental competition study shows average of 24 applicants for every rental in San Diego. The data that I'm seeing and the landlords that I'm hearing from, investors that I'm hearing from, are saying it's way more than that. Way more than that. So I don't know if this is the problem with the news sites. They just constantly want to shove this stuff down your throat. And once I accidentally unmuted it. Please stop. Once like people I'm hearing from, it's like 100. They have to shut off the ads so that they don't continue to get applications. So the rental market has not slowed down at all. Now, while we've seen the purchase market get a little bit easier for buyers, for renters, it's still an absolute frenzy. And that should help buoy real estate. The harder it is to rent and the more expensive it is to rent, then the better it is for real estate. And right now it's hard to rent, and the harder it is to rent, the more expensive it gets to rent. And so there's still one of the things that's underlying, and I've been telling all my investor buddies, you have to look at how much you're getting for rent and make sure you're getting the right amount. A lot of people are still under renting their properties by significant amounts. And if they were getting market rent, those renters would be in the market to buy. I can guarantee you that. So we still have room for landlords to push people towards buying, as well as they correct their rents that they're receiving on the properties that they have. And that is just another thing that I think we can expect, in the course of this year and maybe into next year, is a lot of correction going in that route, in that direction. So for right now, we've got a good jobs report. Rates pulled back just a little bit, our bonds pulled back just a little bit. So rates spiked just a little bit, but not much. I mean, look at the overall move here has been really good. Get a little pullback. It'd be nice if we could just, continue this march higher. It's not a bad Fibonacci right there from this. It's not even I don't even think a 50% retracement. So if we get support there, that would actually be pretty bullish. If that ends up being the bottom of this cycle right here, then that would be a really good sign. So we have some things to really look forward to there, I think. Meanwhile, this jobs report, as I've been telling people, the Fed, if the Fed gets the opportunity, they will 100% guarantee you that they will jump in and do something about it. Having really good jobs numbers kind of puts the Fed on the sidelines. And that's why we very well may see stocks take a hit next week. Very well may see crypto take a hit next week. That all could happen because if the Fed is really that far away, and the dollar, you guys seen the dollar? The dollar is going bananas. Let's see, where is it? DXY. It's over 100. It's at 107. I mean, it is making crazy highs, just relentlessly going higher. Why? Why is that happening? I mean, look at that. That is bananas. It is just marching higher and higher, cascading higher, which is just super, super bullish. And why is that happening? Because the Fed's tightening. So they're actually strengthening the dollar. Imagine that. It's helping the dollar because the Fed is tightening instead of being loose and, printing money and doing all those things. It may be the case if they continue this path. The dollar is actually very strong right now. In fact, if you guys don't follow the Points guy, I think he's on Instagram and other places too, but I follow on Facebook. The Points guy is this guy who's just travel dude who helps you understand where the deals are and stuff like that. And he was talking about how the exchange rate has made it much less expensive to travel abroad, and how the strength of the dollar has actually gotten to the point where it's, you can buy things so much cheaper when you're traveling. So that right there is also, that's good. I mean, that's deflationary information, right? If the dollar is strengthening, that's the opposite of inflation. So do all these things align perfectly? No, they don't. But those are all things, these are macro things that are very, very good right now that we cannot ignore. And listen, I'm not saying that real estate values can't go down. I'm not saying that there won't be a pullback. I'm not saying that some areas won't get even crushed. Totally possible. I'm just saying it is not nearly as bad as most people think. And will it get worse? It could. It could also get a heck of a lot better too. There's a lot of things that could get better. I actually don't think I put that in here, but there was. Oh yeah, Elon has terminated the Twitter deal. Can you imagine paying $1 billion fee? Like your fee to cancel the deal is $1 billion, and you don't even sweat it. You can just write the check, no big deal. There was an assassination in Japan too yesterday. It's crazy. Let's see if I can find this right here. There's big time log jams still happening in, where is this? My bad. I should have pulled it up. There's huge log jams still happening in the supply chain. Huge, on railroads, at ports, all over the place. So now imagine if that supply can come to market, that would be really helpful, right? That would really help, because supply chain issues is something that's gasoline to the inflation fire. So we don't want to see those things. It does not help anything whatsoever. And it would be nice if those things would improve. Right now, for people who are, if you're a buyer who's looking to get a deal in real estate, let me just explain something to you really quick while I put my disclaimer and stuff up. Derrick Evans here, NMLS 155010. Call or text me if you want to buy, refi, get pre-approved. You can email me as well. But if you want, a lot of buyers are saying, well, I'm going to sit back and wait. Okay, well, let me just tell you for certain, in the San Diego market, for sure, sitting on your couch, a real estate deal is not going to just fall in your lap just because you decide to chill. If you really want to get a deal in this market, there is a way to do it. First of all, you need to try to get yourself in a position where you are month to month, or you are flexible with the terms of where you're living. If you can do that, that's a huge advantage. Then you get yourself pre-approved, figure out how much you can afford, what's going to work for you. So when you can start looking at properties that actually meet your criteria and will work for your financing bandwidth. Okay. Then you hawk the market. That's what you do. You watch the market, you watch your price point, you watch the areas you like, you watch it every day, you see what new stuff comes on, you favorite a few different properties that you like the way they look, you see what happens when they close, how long does it take for them to close, what are they closing at, what is the actual sales price. You start actually paying attention and researching the market, because you're not going to get a real estate deal maybe ever again in America by just sitting back and waiting for the market to crash. It may never ever happen again. You realize the only real estate crash we've had in modern history, and I mean, I'm talking about since the television set, was in 2008. That's the only crash we've had. Call, text me if you want to buy, refi, or get a quote. I'll be around this weekend as well. 2008 was the only real estate crash we've had in modern history. It's the only one. We've had a few corrections here and there, and guess what? Every one of those corrections, including the crash, were all opportunities to buy. Every single one. If you bought, you made money. Big time. So while we sit here and we worry about a crash, because the pain is still somewhat recent, right? I mean, it's almost 15 years away, but people remember it. People are aware of it. Remember how ugly it was. It was bad. It was really, really bad. It was about as a worst case scenario as it could be. I can't think of how it could have been worse. The Fed was absent. We had fraud with the ratings agencies. Wall Street was fully involved, but completely detached. Wall Street was totally involved, but they were detached. They were just trading paper, making commissions. They had no investment in real estate. Today, they're invested in real estate, big time. BlackRock is hugely invested in real estate. Wall Street is hugely invested in real estate. Bond replacement, direct property purchases for rentals. They're invested in real estate this time, actually invested in homes, houses, not just paper trading. There's no ratings agency fraud happening. It's virtually impossible now the way they have it set up. Thank goodness. That was one of the good things that came from the financial crisis. Not that fraud can't still happen, but it's much more difficult to do now. And it's on people's radar. It was never on anyone's radar before. So it's on the radar. It's something that's a check and balance. So we have all these things that are going that are just so dramatically different from 2008, but yet a lot of the potential buying populace believes that we're headed for a 2008 style crash. And I can tell you that it's just, there's nothing that I see now that would tell us that. And if we look at recessions historically, the only one in which real estate values went down was, of course, the crash of 2008. Every other one, they go up a little bit, or maybe just sideways. There's no real downside in real estate during those previous recessions, except for the crash. So if we go back and we say, all right, well, it took all of those ingredients in 2008 to make a real estate market crash, and it's the only one we've seen. Do we have that level of fraud and incompetence, or is it less? You know, it's so much different. Just the loans that are being made, down payment people are making, the qualification process. I mean, literally everything is completely different. So it's one of those things. We have to realize that what people are hearing, what the news is going to be feeding them, what's going to be recent in their mind, what's going on in YouTube, freaking YouTubers promote just talking about real estate crashes every day, bunch of bozos. I would love to debate one of these knuckleheads. In fact, maybe that's what I'll start doing. I'll start challenging these fools to debate so we can talk about reality. And they're also stuck in these things. In fact, I saw someone posting today about, well, inventory has gone up so much. Yeah, but look at where it is still. I mean, we need inventory in San Diego County to go up 3x just to get to where we were right before COVID. And at that point in time, everyone was complaining there wasn't enough inventory. So everyone was saying we need more houses. We don't have any. So we're so far away from that. And a lot of the buyers I talk to now, they're saying the same thing. We haven't found anything that we like yet. We're not seeing anything that we like on the market. We're still kind of waiting for something that we're interested in. And that's what's going to happen. This market right now to the end of the year, we're probably going to have kind of the old school real estate market where, buyers are not going to be excited about doing pre-approval and getting their ducks in a row. They're going to be like, I'm not really that interested, but they're going to go to open houses and they're going to go to open door homes and all that stuff. And they're going to find something they fall in love with. And then they're going to call me on a Saturday and say, I need to get pre-approved right away because I got to write an offer on this house. I love it. I love it. I love it. That's the market that we're going to be in. And then if you get your offer in first and you're near list price, you probably get accepted. So I like that kind of market personally. That's the market we're heading into. I think it's great for people to be able to see a home that they like and be able to write an offer and get it accepted. I think that's the way the real estate market should be. It's been absolutely bananas and crazy the last couple of years. I don't think people should, remove their appraisal and inspection contingencies, and now you don't have to anymore. So that's great. If you can remove your appraisal for one reason or another, obviously makes your offer very strong, but it's also nice to not have to do that, right? So that's kind of where we're at. I believe that this is going to be a busy weekend. I'm calling it right now. We're going to have a busy weekend. We had a holiday weekend last weekend, so things are probably a little slower than they would normally be. I think this weekend will make up for it, and we're going to have some serious action in the marketplace. So if you need me, you know where to find me. Shoot me an email, give me a call or text. You want a quote? If you want to get pre-approved, I will be here. Everyone have a tremendous weekend. I hope this helps, and I will see you all soon. Take care.